Hi there, welcome to Kneppy Invest. Every single morning when I wake up, around about 5:30, I check what the American markets did overnight. And this morning was no different, except I woke up about 4 a.m. and straight away, without any hesitation, I just wanted to know what the overseas markets had done, because last night was really important because we saw CPI numbers released, and I knew we'd be able to tell without even looking at the CPI numbers whether they beat expectations or they are higher than expectations or lower than expectations. The Nasdaq down 5% straight away tells me that CPI numbers were worse than expected. In fact, when I looked at the numbers, it was considerably worse than expected. Now, when I say considerably, I'm talking about 0.2% higher than expectations, but core CPI was higher than expectations. And this is a concerning thing, that core CPI numbers, which is taking away energy and food prices, which tend to be more volatile, was up to about 6.3%. And the market absolutely freaked out about these CPI numbers. And that's why the Nasdaq was down 5% for the day. And more than likely, I shouldn't say more than likely, this will follow through to the Australian markets. I do have expectations that the XGO, the XAO, XSO will be down about 2 to 2.5% today, unless we see a little bit of a rally on the futures market in America. But I don't see why anyone will be bullish right now, because with the higher than expected CPI numbers, that means we're going to see further interest rates rising or raises by the Fed in America. And more than likely, we're going to see these CPI numbers translate to Australia as well. And we will see higher interest rates in the future. And we just don't know how much longer this is going to go on. So there was expectations. And leading up to these results, we saw a rally in the market. So the market was expecting, in my opinion, that these CPI numbers were going to be lower than expected, just based off the rally in the markets in the last 3 or 4 days. So it is concerning right now. And I do think, I am a little bit more bearish now than I was a few days ago, even yesterday, just based on what happened overnight. Now, I've already mentioned that there was a bit of a rally in the markets in the last 3 or 4 days. We saw the Nasdaq up 4 days straight. And I think this was particularly leading up to the release of CPI numbers. I think the market was expecting these CPI numbers to be actually better than expected. And you can see that in a bit of commentary. This is from Jim Cramer. The Fed may be winning against inflation. And of course, we all hope that and wish that is true. And this is a tweet from Will Mead before CPI numbers were released. Huge inflation number tomorrow. Word on the street, CPI will show inflation is falling. If true, hedge funds will get squeezed as they are net short a record 107 billion in S&P futures. So again, I think the market was expecting CPI numbers to be lower than expected or be about around expectations. And if they were worse than expectations or higher than expectations, the CPI will actually show inflation is now rising, and it is rising. So even though it only rose 0.1% in August, CPI numbers is still over 8% and worse than expected. But the other thing is core CPI. And I think that is the most important thing, because that takes away the volatile energy and food prices. And you'll notice at the oil pump, the petrol pump, petrol prices are coming down. And leading up to this, the whole reason why we've got this inflation, this is from a lot of commentators out there, whole reason we've got inflation is because of rising oil prices. But oil prices have pulled back. So inflation should be falling because of that. But inflation is widespread throughout the community. And even though oil prices have fallen, we're still seeing rising prices in a lot of services and also food prices as well. And I love this tweet from Few, because this tells us how important inflation is right now. In fact, this is the major driving force behind the movement in the markets, whether it's going up, we're in a bull phase, or going down in a bear phase, because the Fed has only 2 mandates. The first mandate is full employment. The second mandate is price stability, which means inflation. They want inflation to be around 2% because that is price stability. So right now, with full employment in the United States, the main focus of the Fed is inflation and bringing inflation back down to say between 2 and 3%. So this tweet from Few tells us what our expectations to the markets are going to be, or were going to be today, based off the CPI numbers. For instance, the expectations were 8.1. And if the market was right, say between 7.9 and 8.1, that means it's, two expectations, neither bearish nor bullish. If CPI numbers were less than 7.9, that was going to be a bullish move. So we would have seen the Nasdaq and other markets rise quite a bit overnight. If the CPI numbers were greater than 8.1, that would have been bearish, worse than expected. And if they were higher than 8.5, that would have been very bearish. Luckily, we didn't get to 8.5, but we were close, 8.3. This is the Nasdaq Daily going back to March of this year. And overall, I do think we're still a little bit bearish, even though we did see that, or have seen the market rally on 2 occasions in the past few months. Now, the last rally was only over 4 days. So again, you can see the Nasdaq was up 4 days in a row leading up to the release of these CPI numbers. So I think the market was expecting CPI numbers to be better than expected. I think the main reason they expected CPI numbers to be better than expected were because of the falling oil prices. But I think everyone needs a bit of an adjustment, a bit of a rethink in regards to inflation. This is not, what's that word they used to study? Transitory. This is definitely not transitory. I think that word has now left our vocabulary. And obviously it has left my vocabulary because I forgot what that word was for a little bit there. But I think how long this inflation persists for might have to be rethought. I think this can be a projected event in relation to higher inflation. A lot of expectations that inflation is going to fall to say 3% over the next year. I think this could be a protracted event in regards to inflation, and that would be bad for the economy and bad for the markets, equity markets around the world, not only equity markets, a lot of other asset markets also. So we saw that 4-day rally, and then the Nasdaq has pulled back towards the top, the bottom of that 4-day rally. So all that rally, those 4 days of the market up, has been wiped out in just one trading day, and that's why the Nasdaq is down 5% today. Now, what's going to happen over the next few days? I could see the markets or the Nasdaq fall even further, say towards 11,000. And the reason why 11,000 is fairly significant level is that's the old low we saw back in June, around about to the middle of June. And if the Nasdaq falls below that old low, that would be a very bearish move. So all eyes on that low we saw back in the middle of June. Now, something I found really interesting is every single component or member of the Nasdaq 100 was down for the day. This doesn't happen all that often. In fact, only 13 times over the past 25 years. 3 times in 2008, 4 times in 2011. Last time it happened was the 12th of March, 2020, during the COVID-19 financial panic. But the most interesting thing about this data, and it is a small sample size, only 13 members in this sample, is that 12 months later, the market has seen a significant rally. In fact, in 12 of these 13 occasions, the Nasdaq was more than 10% higher 12 months later. And the only time it wasn't 10% higher, or at least 10% higher, was in 2018, and it was still 7.7% higher. So a really good argument right now is we should be really bullish about where the market or the Nasdaq is going to be in 12 months' time based off this 13 sample size. And I think the reason behind this is a lot of times when we see every single member in the Nasdaq down on a particular day is during the later period of a bear market or a correction, and then we see the market rally. So some optimism here that in 12 months' time, say September 2023, the Nasdaq is going to be considerably higher than it is right now. Now on to why the markets were down big, and I've already talked about this, so this is no surprise. A couple of tweets here from Benjamin Cohen and Gareth Soloway, who both of these people I do, actually Gareth Soloway I do follow. He's actually been on a few podcasts on small caps, so he does find his way into Australian podcasts. But anyway, the reason I've included this Benjamin Cohen, because this is very simple. Why the market was down big overnight. Headline inflation, 8.3% versus expectations of 8.1%. So everything is about what these numbers are, CPI numbers are, compared to expectations. It's not the number itself. It's based off comparison to expectations. And core CPI, 6.3%, higher than expected as well. And then Gareth Salloway puts this in context. Yikes on inflation locks in a 75 basis points hike for September, increases the likelihood the Federal Reserve will have to over-tighten, thus pushing the economy into a recession, at which point they won't be able to get the economy out of recession as inflation remains elevated. And so this increases the probability we might be moving into a period of stagflation. And a period of stagflation is the worst thing for every single person. And this is a tweet from TradingView, just shows you the effect that CPI, or these CPI numbers, had on the market. And this is the immediate reaction from S&P 500, gold, Bitcoin, and the Euro-Dollar or Euro-American dollar after the CPI was released. A significant correction to these numbers. So this is telling us straight away the whole reason the markets were down big overnight was because of CPI numbers. Sometimes when the market is down, say 1 or 2%, there is a little bit of uncertainty why the market was down 1 or 2%. There is no uncertainty why the market is down 5 or the Nasdaq is down 5% overnight. It's all because of the CPI numbers. Now, in my opinion, the biggest or most concerning thing about these CPI numbers is the core CPI. In fact, core CPI is increasing right now. So it did look like it was coming down 4 or 5 straight months where core CPI was falling. Now it's starting to rise again. And core CPI is the thing to keep an eye on. If that keeps on rising, we're going to see main CPI, unless we see significant decrease in oil, say if oil falls to say $40 a barrel, which I think is completely unlikely. I think if we continue to see core CPI numbers rise, that is going to be really bad for the economy, and we're going to keep on seeing interest rates rising from here. So I think the most concerning thing about these CPI numbers is that core CPI number and the fact that that is now back to rising. And another really concerning thing about the CPI numbers is food inflation, or the food component of CPI. So this is not, if I remember correctly, not a part of core CPI, but food is very important. We all need to eat. We are going to spend money on food. And the food component of CPI inflation rose by 11.4% year on year, up from 10.9% prior, and is the fastest rate we've seen since April 1979. So this is a tweet from Liz and Sunders. And this is another really concerning thing we are now seeing, is this rise in food inflation. So why has the American markets reacted so negatively to these CPI numbers? This is an article from the Wall Street Journal. Inflation report keeps Fed on aggressive rate rise path. There was a hope that if underlying prices and inflation was lower than expected, that means there would be a slower pace of interest rate rises and a possibility that we're moving towards the top of the interest rate cycle. I think these CPI numbers means that we're not near the top of the interest rate cycle. And in the next paragraph of this article, or the first paragraph of this article, the acceleration in inflation last month clinches the case for the Federal Reserve to lift interest rates by at least 0.75 percentage points at its meeting next month, and raises the prospect of hefty increases continuing in coming months. And that's why the market is freaking out about these CPI numbers. And further to add to that, this is a tweet from Gold Telegraph. Janet Yellen today, or warned today, that the Federal Reserve is going to need great skill and also some good luck to achieve a soft landing. So the talk over the past few months is all about soft landing, and the probabilities of a soft landing right now is significantly lower because of these CPI numbers. And then Gold Telegraph decides to put their own thoughts into this. She has finally changed her tune. The jokes continue to write themselves in 2022. So the future is uncertain, but I think the soft landing and hard times or soft landing is much less likely, and hard times moving forward are much more likely now. I think this really increases the probability of a recession, and a significant recession at that. And here is a tweet from Forex Live, and I think this was just before the release of CPI numbers. The Fed funds future now pricing in, or this might have been just after, Fed pricing now, futures now pricing in 11% chance of 100 basis point hike right next week. And then they reply to themselves and mention it's now, probability is now up to 23%. So there was that talk about that 75 basis point rise. Now there's a chance it could be as high as 100 basis points. And lo and behold, before all these CPI numbers were released, there was this tweet from Breaking Market News in relation to the head of Germany's BDI Industry Association saying that they expect a massive recession in Germany. And this shouldn't be a surprise, because I think a lot of European companies are moving towards a significant recession. And I think now with these CPI numbers, there's an increasing chance the United States is moving towards a significant recession in the future. And the Fed isn't concerned about that. They're more concerned and only concerned about inflation. And if America moves into recession, they're not concerned about that. We saw this in the late 70s, early 80s with Paul Volcker, when they had really high inflation, and to solve really high inflation, they kept on pushing up interest rates. That was the solution back then. That is a solution right now. So don't be surprised if they can't control inflation and move inflation back down to 2 or 3%. Keep on seeing, we're going to keep on seeing interest rates rising from here. And that's going to have a really negative impact on the economies around the world. That's all I have on this video. Time right now is 10 o'clock. So I've got to have to check the openings of the market. Won't be surprised to see the market initially down 2%, and it might keep on falling during the rest of the day unless we see a bit of a rise in the futures. But overall, the reason why the Nasdaq and the American markets were down big overnight was all because of CPI numbers being worse than expected. That's the main thing. It's all about expectations and the numbers in relation to those expectations. If the numbers are worse than expected, you're going to see lots of bearish sentiment out there. If numbers are better than expected, there's going to be a lot of bullish sentiment out there. If you have any questions about anything I've talked about today, I'd love to hear your thoughts, your questions, your opinions. So leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a great day. Bye.